Ever heard someone say the market is up or the market is down? What market are they even talking about? Chances are they're talking about the S&P 500, and if you've ever felt a little lost when that term gets thrown around, don't worry. By the end of this video, you'll understand it better than most people on Wall Street. So, what exactly is this mysterious S&P 500? Let's break it down. The name stands for Standard & Poor's 500. Standard & Poor's is the company that created it, and the 500. Well, that's the magic number. It represents 500 of the largest and most influential publicly traded companies in the United States. Think of the biggest names you know: Apple, Microsoft, Amazon, Google, Tesla. Yeah, they're all in there. It's like the all-star team of American business. But it's not just a random list of 500 big companies. There's a specific recipe. A committee at Standard & Poor's actually handpicks these companies. They look at things like how big the company is, how much of its stock is available for the public to buy and sell, and if it's actually making money. They want the index to be a true snapshot of the US economy's health. So, if these 500 companies are doing well, it's a good sign the overall economy is doing well. If they're struggling, it might signal a slowdown. Now, here's a key point. The S&P 500 is what we call a market capitalization weighted index. That sounds complicated, but the idea is simple. The bigger the company, the more influence it has on the index's value. Think of it like a group project. The person who does the most work has the biggest impact on the final grade. So, a huge company like Apple moving up or down by a few percent will have a much bigger effect on the S&P 500's overall value than a smaller company in the index moving by the same amount. This means the giants at the top really steer the ship. Why should you even care about this? Well, for a few big reasons. First, it's a benchmark. It's the yardstick that professional investors use to measure their own performance. If a fund manager says they had a great year, the first question is, did you beat the S&P 500? If the S&P 500 went up 20% and their fund only went up 10%, well, that's not so great after all. It helps keep everyone honest. Second, and this is the important part for you, it's one of the easiest ways for anyone to start investing. You can't directly buy the S&P 500 itself, it's just a list, a number. But you can buy something called an index fund or an ETF, an exchange-traded fund that is designed to mirror the performance of the S&P 500. When you buy a share of one of these funds, you're essentially buying a tiny little slice of all 500 companies at once. Think about it. Instead of trying to pick the next big winner and risking it all on one or two stocks, you get instant diversification. You own a piece of the tech industry, the healthcare sector, banking, consumer goods, you name it. If one company or even one whole industry has a bad year, you have 499 other companies to help balance it out. This is why people like Warren Buffett have famously said that for most people, a low-cost S&P 500 index fund is the best investment they can make. It's simple, it's diversified, and historically, it has performed incredibly well over the long run. Let's talk about that history. The S&P 500 has been around in its modern form since 1957. Over that time, it has gone through crazy ups and downs. We've had recessions, market crashes, wars, and all sorts of global crises. But if you look at the long-term chart, the trend is undeniably upward. The average annual return over the long haul has been around 10%. Now, that's not guaranteed. Some years it's up 30%, other years it's down 20%. But if you stay invested for the long term, think 10, 20, or 30 years, the power of compounding those average returns can be absolutely life-changing. Let's put this into perspective. If you had invested just $10,000 into an S&P 500 index fund 30 years ago and just left it alone, today it would be worth over $200,000. That's without adding another penny. That is the power of owning a piece of the 500 best-run companies in America and just letting them do their thing. But wait a minute, you might be thinking, what about those market crash? The dot-com bubble in 2000, the financial crisis in 2008, the crazy drop in 2020. Yes, those happened, and when they happen, it's scary. Seeing your investment value drop by 30 or 40% is tough. It makes you want to sell everything and run for the hills. But history has shown us, time and time again, that the market always recovers. Every single major downturn in the S&P 500's history has been followed by an eventual recovery and new all-time highs. The key is having the discipline to not panic sell. The real money is made by staying in the game and even buying more when prices are low, if you can. So how do you actually do it? It's easier than ever. You can open a brokerage account online in minutes with companies like Fidelity, Vanguard, or Charles Schwab. Once you have an account, you can search for an S&P 500 ETF. Some of the most popular ticker symbols are SPY, IVV, and VO. You buy shares of these just like you would buy a share of any single stock. The fees for these funds are incredibly low, often just a few dollars a year for every $10,000 you invest. This is a huge deal because high fees can eat away at your returns over time. Now, here's a crucial thing to remember. The list of 500 companies isn't set in stone, it changes. The committee I mentioned earlier meets regularly to review the list. Companies that are no longer big enough or profitable enough get kicked out, and no, rising companies get added. This is actually a feature, not a bug. It means the index is self-cleansing. It automatically gets rid of the losers and adds the winners, so it always represents the current state of the American economy. Think about it, companies that were huge decades ago, like Kodak or Sears, are no longer in the index. They were replaced by the innovators and leaders of today. So, to recap, the S&P 500 is a list of 500 of the biggest US companies. It's weighted, meaning the biggest companies have the biggest impact. It's the most common benchmark for measuring the health of the US stock market and the performance of investors. And most importantly, through low-cost index funds and ETFs, it offers you a simple, powerful, and historically proven way to build wealth over the long term by investing in a diversified portfolio of America's best businesses. It's not a get-rich-quick scheme, it's a get-rich-slowly and steadily plan. And in the world of investing, slow and steady almost always wins the race. So next time you hear on the news that the market is up, you'll know exactly what they're talking about. And more than that, you'll know how you can be a part of that success. It's not some exclusive club for the rich, it's accessible to everyone. Thanks for sticking with me through all that. If you found this helpful and want to learn more about investing in a simple, no-nonsense way, make sure to hit that like button and subscribe for more videos. Let me know in the comments if you have any questions. See you next time.